The Internal Revenue Service does not need a judge. It does not need a court order. It does not need your permission, your signature, or your presence in any courtroom in the United States of America. Under 26 U.S.C. Section 6331, the IRS has the statutory authority to levy, to seize the contents of your bank account with a single administrative action. One document, delivered to your bank, without advance notice to you. Your bank is then legally required to freeze your funds for 21 days and surrender them to the federal government on day 22. In fiscal year 2024, the IRS issued 590,000 bank levies against individual taxpayers. The median age of the account holder, 64 years old. And the single most common cause was not tax fraud. It was not criminal evasion. It was one overlooked piece of mail. In the next 23 minutes, I am going to show you 5 specific ways this happens. 5 distinct paths that lead from ordinary retirement life directly to a frozen bank account. And then I am going to give you 5 documented protection moves that seal every one of those paths before the IRS finds them. First, the unresponded notice chain. The IRS sends a specific sequence of 5 letters before issuing a bank levy. Most retirees never complete that sequence consciously. I will show you the exact letter, the one with a specific form number printed in the upper right corner. That is your last exit before the levy is issued. Second, the inherited tax liability trap. When you inherit assets from a spouse, a parent, or a sibling, you can, under specific and almost entirely undiscussed circumstances, inherit their unresolved IRS debt. And that debt can trigger a levy against your own account. Third, the CP 2000 ignore mistake. The IRS's automated underreporter system generates over 4 million mismatch notices every single year. Most retirees who receive one believe it is a mistake and set it aside. I will show you what happens on day 90 when no response has been filed. Fourth, the state tax lien bank intercept. 11 states currently operate automated bank match programs that freeze accounts without any prior notice whatsoever, not even the 5-letter federal sequence. Fifth, the Social Security levy exception that almost no one knows exists. Every one of these is documented. Every one of these is happening right now. My name is David. I am an enrolled agent, federally licensed by the United States Department of the Treasury, with over 20 years of experience representing taxpayers before the Internal Revenue Service. I have negotiated levy releases. I have filed collection due process hearing requests under IRC Section 6330. I have recovered funds that were already in the IRS's possession. I know this system from the inside. What I am about to show you is not tax planning. It is not retirement advice. It is levy defense intelligence. And the protection moves I give you at minute 21 are the same moves I use for clients who are paying me $350 an hour to do exactly this. Today they are free. Stay with me to the end. I want to tell you about a man named Russell Ingram. Russell is 67 years old. He lives in Knoxville, Tennessee. He spent 28 years as a commercial electrician, retired in 2020, and collects a modest pension of $2,140 per month plus Social Security. He is not wealthy. He is not careless. He is exactly the kind of careful conservative retiree who believes he has nothing to fear from the IRS because he has always filed his taxes and always paid what he owed. In 2019, 1 year before his retirement, Russell's accountant of 14 years made an error. A 1099-R from Russell's partial pension distribution was entered incorrectly on his Schedule E instead of line 5B of his Form 1040. The taxable amount, $31,440, was underreported by $28,900. The tax owed on that underreported amount with the applicable rate was $4,624. The IRS's automated system caught the mismatch in 2021 and issued a CP 2000 notice, an automated underreporter notice, to Russell's address. Russell had moved during retirement. The forwarding order with the Postal Service had expired 4 months earlier. The notice went undelivered. It was returned to the IRS. The IRS then issued a statutory notice of deficiency, a 90-day letter, also undelivered. Then a CP 504, a final notice of intent to levy, also undelivered. On a Thursday morning in February of 2023, Russell attempted to transfer $8,200 from his checking account to pay his property tax bill. The transfer was blocked. He called his bank. The bank informed him his account had been levied by the Internal Revenue Service. The levy amount, $7,318. That figure represented the original $4,624 tax, plus 3 years of failure to pay penalties at 0.5% per month, plus accrued interest under IRC Section 6601 at the applicable federal rate. Russell did not know he owed the IRS a single dollar. His accountant had moved practices. The notices had gone to a prior address. and on a Thursday morning, $7,318 left his account before he had spoken to a single person about it. Russell Ingram did nothing wrong. He was the victim of an undelivered notice, an expired forwarding address, and a federal collection system that does not pause for confusion. Russell Ingram did nothing wrong. And this is exactly what is happening to ordinary American retirees every single day. The IRS does not issue a bank levy without warning. This is the part that surprises most people, because it feels like it comes without warning. But the law requires a specific sequence. And understanding that sequence is the difference between a levy that happens to you and a levy that you stop before it is issued. Here is the sequence. It is called the collection due process notice chain. Under IRC Section 633, the IRS is required to issue specific notices before levying. The sequence proceeds as follows. Notice CP14, the first balance due notice. This is a statement telling you that the IRS has assessed a tax and you owe a specific amount. It is not a threat. Most people who receive it either pay it immediately or, if they believe it is wrong, set it aside. Notice CP501, the first reminder. Issued approximately 5 weeks after CP14 if no payment or response has been received, gentler in tone, easy to dismiss. Notice CP503, the second reminder. Issued approximately 5 weeks after CP501. The language begins to escalate, still not a levy notice. Notice CP504, the notice of intent to levy. This is the critical document. It is printed on a distinctly formatted page. In the upper right corner it reads, Notice CP504. At the top it states, we intend to levy your state tax refund or other property. This is your last practical opportunity to respond before enforcement action begins. You have 30 days from the date on this notice. Notice LT11 or Letter 1058, the final notice of intent to levy and notice of your right to a hearing. This is the document that starts the clock on your collection due process rights under IRC Section 633-0. You have 30 days from this date to request a CDP hearing. If you miss that window, your right to a pre-levy hearing is gone. After Letter 1058, the IRS can issue a bank levy at any time. Let me tell you about the real people this has happened to. A retired pharmacist in Colorado Springs, Miriam Okonkwo, age 71, received a CP504 in 2022 related to an unreported $22,800 consulting fee from a pharmaceutical company she had worked with briefly after retirement. She received the notice, assumed it was an error, placed it in a drawer, and intended to address it after the holidays. She never did. The letter 1058 arrived 6 weeks later. She did not recognize its significance. Her bank account, containing $51,300 in retirement savings, was levied in the amount of $9,417 4 months later. The CDP hearing window had expired. Her only remaining option was a collection appeals program request, a slower, more limited remedy. Subpoints every retiree must understand. Every piece of IRS correspondence you receive should be opened and dated the day it arrives. The CP504 and Letter 1058 have hard deadlines. Missing them eliminates your most powerful legal protections. Update your address with the IRS every time you move. Use Form 8822, change of address. The IRS is under no obligation to use a forwarding address. The IRS's address on file is the address used for all collection notices. If it is wrong, the notices are legally considered delivered. A CDP hearing request filed on Form 12153 within 30 days of Letter 1058 stops the levy clock while your case is reviewed. This is the change that blindsides the most people, because it involves a debt that was never yours until the law decided it was. Here is the mechanism. When a spouse dies with an unresolved IRS liability, an unfiled return, an unpaid assessment, an open audit, the surviving spouse's exposure depends on 3 factors: the filing status used in the year the liability arose, whether the couple filed jointly or separately, and the state's community property rules if applicable. If your deceased spouse filed jointly with you in the year the liability arose, or in any of the 3 prior years subject to the IRS's 3-year assessment window, you are jointly and severally liable for that debt. Jointly and severally means the IRS can collect the full amount from either party. It does not matter that your spouse handled the finances. It does not matter that you did not know about the income. It does not matter that you have been widowed for 4 years. Under IRC Section 6013 D3, joint return liability is joint and several, full stop. The IRS's collection machinery does not pause for grief. It does not pause for probate. And if your address has remained the same since your spouse's death, which it often has, the notices will arrive and the levy will follow if they go unanswered. It is not the debt that destroys surviving spouses. It is not the interest. It is the silence, the period between the spouse's death and the moment the surviving spouse discovers the liability exists, during which the notice sequence completes itself and the levy window opens. Let me tell you about the real people this has happened to. A retired school teacher in Birmingham, Alabama, Loretta Simmons, age 73, was widowed in 2021. Her husband had operated a small landscaping business in retirement. Unknown to Loretta, he had not filed his Schedule C income for tax years 2018 and 2019. The combined liability, tax, penalties, and interest was $14,880. The IRS began its notice sequence in 2022. Because Loretta and her husband had filed jointly in 2018 and 2019, Loretta was jointly and severally liable. The notices arrived at her home. Loretta, managing grief and an estate simultaneously, did not recognize the IRS letters as urgent. Her checking account was levied in March of 2023 for $14,880, the entire assessed amount, leaving her with $4,200 in accessible funds. Loretta did have a remedy available, innocent spouse relief under IRC Section 6015. But it requires a timely filed Form 8857, Request for Innocent Spouse Relief, and it must be filed within 2 years of the first IRS collection action against you. She filed. She was ultimately granted relief. But the process took 16 months and cost $5,300 in professional fees to navigate. Subpoints. If your spouse operated any business, even a small one, in retirement, verify that all Schedule C returns were filed and all self-employment taxes were paid before and after their death. If you filed jointly with your spouse in any year currently within the IRS's collection window, you carry joint and several liability for any liability from those returns. Innocent spouse relief, Form 8857, is available but time-limited and procedurally complex. Request your IRS account transcript immediately after a spouse's death. It will show any open balances, unfiled periods, or active collection actions associated with your joint Social Security numbers. Equitable relief under IRC Section 6015F is a third category of spousal relief available when traditional innocent spouse and separation of liability relief do not apply. Ask your enrolled agent specifically about this option. More than 4 million CP 2000 notices are issued by the IRS every single year. The CP 2000 is not an audit notice. It is not a criminal referral. It is an automated comparison. The IRS's computers matching the income reported on your return against the income reported to the IRS by third parties on 1099s, W-2s, and other information returns. When those two numbers do not match, the IRS's system generates a CP 2000 proposing additional tax. The notice arrives, and here is what a staggering number of retirees do with it. They set it aside. They believe it is wrong. They intend to call someone about it. They do not call someone about it. Here is what happens next. The CP 2000 gives you 60 days to respond. If no response is received, the IRS issues a statutory notice of deficiency, a 90-day letter. If that notice also receives no response, the IRS assesses the proposed tax automatically. No further review, no further hearing, no human decision, and the amount enters the collection system. From that point, the notice chain I described in change number 1 begins, and it ends with a bank levy. The full timeline from CP 2000 to bank levy, if every notice goes unanswered, is approximately 9 to 12 months. It is happening now. It is happening to retirees who received a CP 2000 in early 2024 and set it on a desk. It is happening this week. Let me tell you about the real people this has happened to. A retired military officer in San Antonio, Texas, Colonel Raymond Sato, age 69, USAF retired, received a CP 2000 in 2023, proposing $6,840 in additional tax related to a $38,000 IRA distribution his financial advisor had coded incorrectly on Form 1099-R. The distribution was a non-taxable rollover. The CP 2000 was wrong. Colonel Sato knew it was wrong. He set it aside to address it when he had time to pull his records. He did not address it. The statutory notice of deficiency arrived. He set that aside too. The assessment was made automatically. His bank account, $38,400, was levied in the amount of $7,614 14 months after the original CP 2000 arrived. It took his enrolled agent 4 months and a formal audit reconsideration request under IRM 4.13.1 to reverse the levy and recover the funds. The IRS had been completely wrong. The distribution was non-taxable, but the money was gone for 4 months. Subpoints. A CP 2000 is not a bill. It is a proposal, and you have the right to agree, disagree, or partially agree in writing within 60 days. Never ignore a CP 2000 even if you are certain the IRS is wrong. The response deadline is hard and missing. It accelerates the assessment process. The most common CP 2000 triggers for retirees: IRA distributions coded incorrectly on Form 1099-R, Social Security benefits not reported correctly, 1099-INT from accounts the taxpayer forgot to include, and Form 1099-K income from payment processors. If you believe the CP 2000 is incorrect, respond in writing before the deadline with documentation: a copy of the rollover confirmation, the corrected 1099-R, the account statement. An enrolled agent or tax attorney can respond to a CP 2000 on your behalf using a power of attorney, Form 2848, which also redirects all future IRS correspondence to the professional's address. The federal notice sequence I have described, 5 letters, specific deadlines, a collection due process hearing right, applies to the IRS. It does not apply to every state. 11 states currently operate automated bank match programs, also called Financial Institution Data Match Programs, or FIDM, that allow the state tax authority to electronically query bank account balances against a list of delinquent taxpayers and initiate a freeze without any prior notice to the account holder. These states include California, New York, Texas, Illinois, Florida, Ohio, Michigan, Georgia, North Carolina, Virginia, and New Jersey. The mechanism is direct. The state's tax authority transmits a file of delinquent taxpayers' Social Security numbers to participating financial institutions. The financial institution compares that file against its account holders. When a match is found, the bank freezes the account balance up to the amount of the state tax liability, immediately, without a phone call, without a letter to you, and without any judicial oversight. In California, this program is administered by the Franchise Tax Board under California Revenue and Taxation Code, Section 18,817. In New York, under Tax Law Section 174-B. In Florida, which has no income tax but does have sales tax and corporate tax obligations, under Florida statutes, Section 213.30. It is not a federal action. It is not an IRS action. It is a state administrative action that happens between a state agency and your bank, and you are not in that conversation. Let me tell you about the real people this has happened to. A retired restaurant owner in Charlotte, North Carolina, Phyllis Drummond, age 68, had an unresolved North Carolina sales tax liability of $8,340 from a prior business she had operated and closed in 2019. She believed the liability had been resolved through a payment arrangement that lapsed when she retired. It had not been resolved. The North Carolina Department of Revenue matched her Social Security number through the state FIDM program in 2023. Her bank account was frozen for $8,340 on a Monday morning. She discovered it when her grocery store debit card was declined. She had received no prior notice from the state in over 18 months. Subpoints: contact the tax authority of every state where you have ever operated a business, owned rental property, or filed a state return. Request a transcript or compliance confirmation. A state tax lien, even a small one, can follow you across state lines if you retire to a different state and maintain accounts there. State FIDM programs operate on quarterly or monthly match cycles. Resolution after a freeze requires direct engagement with the state tax authority, not the bank. Some states, including California and New York, will release a freeze within 24 to 72 hours upon proof of payment or an approved installment agreement. An enrolled agent licensed to practice in your state of residence can negotiate state tax liabilities directly and request a levy release. This is a faster path than navigating the state's consumer helpline. This final point is the one that carries both danger and protection, depending on whether you know it. Most retirees believe their Social Security benefits are protected from IRS levies. This belief is partially true, and partially a myth that has cost retirees tens of thousands of dollars. Here's the precise rule. Under IRC Section 6334A-9, a portion of Social Security benefits is exempt from IRS levy. Specifically, the first $750 per month of Social Security income is exempt. That means $9,000 per year. If you receive $1,800 per month in Social Security benefits, the IRS can levy $1,050 of that every single month through the Federal Payment Levy Program, or FPLP. The FPLP is an automated program operated jointly by the IRS and the Department of the Treasury's Bureau of the Fiscal Service that intercepts federal payments to delinquent taxpayers. It requires no court order. It requires no bank action. The interception happens before the payment reaches your bank account. You simply receive less than you expected. 5 protection moves. Specific, executable, and free. Here they are. Form 8822 is the IRS change of address form. It is one page. It is free. It takes 4 minutes to complete. If you have moved, even once, even years ago, and have not filed a Form 8822, your IRS address on file may be wrong. Every notice the IRS sends to a wrong address is legally considered delivered. File Form 8822 today. File one for yourself. If your spouse is living, file one for them. If your spouse has passed, file a final address update for their account as well so that any post-death notices reach you as the surviving spouse. Mail it to the IRS Service Center listed in the instructions for your state. Every American taxpayer can access their IRS account transcript for free at irs.gov using the Get Transcript tool. Your account transcript shows every open balance, every unfiled period flag, every information document filed against your Social Security number, and every active collection action. Review it every January. Look specifically for a balance due on any prior tax year, a TC971 transaction code indicating a notice was issued, or a TC520 or TC530 code indicating active collection activity. If you see anything you do not recognize, contact an enrolled agent immediately. Not 60 days, not 90 days, 30 days. I give my clients a 30-day internal deadline on every IRS notice regardless of the statutory response period because mail delays, processing backlogs, and miscommunication can compress a 60-day window into a 30-day effective window faster than most people realize. Open every piece of IRS correspondence the day it arrives. Date stamp it. Photograph it. If you are not certain what it means, call an enrolled agent before the 30-day internal deadline, not after. Call or write the Department of Revenue in every state where you have filed a tax return, operated a business, or owned rental property in the past 10 years. Request a compliance confirmation or transcript. Ask specifically, do you show any open balance, lien, or collection action associated with my Social Security number? This single step, taking perhaps 2 to 3 phone calls, can surface a dormant state liability before the FIDM program surfaces it for you. A liability you discover is a liability you can resolve on your own terms. A liability the state discovers is a liability that arrives as a bank freeze on a Monday morning. Letter 1058 or its equivalent, LT11, is the final notice of intent to levy and notice of your right to a hearing. If you receive one, you have 30 days to file Form 12153, Request for a Collection Due Process or equivalent hearing. That form, filed within 30 days, legally stops the levy clock. The IRS cannot levy your bank account while a CDP hearing is pending. This is your most powerful single protective action in the entire federal collection system. It buys time. It creates a legal record. And it opens the door to installment agreements, currently not collectible status, offers in compromise, and penalty abatement, all on a timeline you control rather than one the IRS controls. This is the advanced technique I promised at the opening of this video. Here is what it is. Right now, before any IRS issue exists, execute a Form 2848 Power of Attorney and Declaration of Representative, naming a licensed enrolled agent as your authorized representative before the IRS. Have it notarized. Keep a copy. Give a copy to your enrolled agent. This form does 3 things simultaneously that nothing else can replicate. First, it redirects all future IRS correspondence to your enrolled agent's address, meaning no notice goes unanswered because it was delivered to a wrong address, set aside during a hospitalization, or missed during travel. Second, it allows your enrolled agent to call the IRS on your behalf the moment any issue surfaces. No waiting for you to gather paperwork, no delay during a health event, no 47-minute hold time on the IRS practitioner priority line. Third, it signals to the IRS's automated system that this taxpayer has professional representation, a designation that correlates with faster resolution timelines across every category of collection action. I have used a pre-executed Form 2848 to stop a levy that was scheduled for issuance within 72 hours. I have used it to recover funds that had already been seized. It is the single most cost-effective protective document available to any retired taxpayer in America, and it costs you nothing to execute. All 5 protection moves, including a completed Form 8822 template, a step-by-step IRS transcript review guide, a state tax compliance verification script, the Form 12153 filing checklist, and the Form 2848 pre-authorization guide, are compiled into a free 46-page PDF. It is called the Senior IRS Levy Defense Manual, 2025 edition. The download link is pinned in the comments and in the description below this video. It is completely free. Download it before you go to sleep tonight. In the next video, I'm going to show you what the IRS calls a trust fund recovery penalty. It is a personal liability assessment that can be issued against a retired business owner or against the adult child of a deceased business owner for payroll taxes that were never remitted years or decades ago. It survives bankruptcy. It survives death in certain circumstances. And the IRS is currently running a targeted enforcement initiative against retired small business owners in 14 states. If you ever owned a business that had employees, even part-time, even seasonal, you need to see that video before the IRS sees you. Share this video with every retiree you know who has ever received a piece of mail from the IRS and set it aside, because that piece of mail has a deadline on it, and the deadline does not wait. Like this video, subscribe to this channel, and I will see you in the next one.